Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at safe and green holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
All right, so with Safe and Green, we are looking at a company that is really in the middle of a massive, massive change.
Oh, absolutely. I mean, for the longest time, everyone knew them for modular home construction. But the management team has, well, they've basically thrown that entire playbook out the window.
It's more than just a small pivot, right? This is a complete strategic overhaul. They formally exited modular homes just last month.
Completely. And this seems to be guided by the new leadership, from the merger with Allenox and NEHD.
So what's the new vision then? Where are they headed?
The new vision is incredibly ambitious. They're aiming to become a vertically integrated energy producer.
Okay, so from homes to energy, how are they making that leap?
Well, this is the smart part. They're leveraging what they already know, containerized construction, but they're applying it to energy infrastructure.
So things like modular data centers.
Yeah.
Bitcoin mining units.
Exactly. Containerized generators, even micro refineries. The idea is to use their core skill in a much higher growth and hopefully higher margin sector.
Right. And for the bull case to work, a lot of this hinges on their energy subsidiary, Allenox, actually delivering.
It all comes down to execution there. And we just saw a huge step forward.
You're talking about the DOT number.
That's the one. It sounds like, just administrative paperwork, but the implications are really significant.
So it's like the key that starts the engine. What does it let them do?
It lets them finally mobilize their own service equipment, their rigs, their trucks, all of it. They can now start servicing their own oil and gas wells.
Which means they don't have to hire expensive contractors.
Precisely. That's a huge operational expense just wiped off the books. It's a direct path to better margins on the oil they're already producing. Efficiency 101.
But I saw something about them not just saving money, but making money with this.
Yes, and that's the next layer. They plan to immediately turn this into a third-party service, offering well maintenance and support to other operators in the area.
So it becomes a new revenue stream.
A high-margin one, hopefully. And they're not just competing with, standard equipment. They're talking about deploying proprietary tech.
I saw that. They mentioned ultrasonic cleaning and plasma pulse tools. What exactly is that?
So that's all about enhanced oil recovery. Think of an old well as a clogged pipe. This tech, especially plasma pulse, sends these microshocks downhole
To break things up.
to break up the rock and clean out all the gunk that's blocking the oil flow. It's a high-tech way to get more oil out of existing assets without having to re-drill everything.
So the story they're telling is transition out of homes, build a high-tech energy services business, and then use the cash from that to fund their own drilling.
That's the roadmap. And it's an aggressive one. They're talking about a big drilling push starting late 2025, aiming for 1,000 barrels of oil per day by the end of 2026.
And that 1,000-barrel target, that's the magic number for them to hit cash flow positive, right?
That's the goal management has laid out for 2026. A very neat, compelling story for the future.
But, and this is a big but, that's the story of tomorrow. The reality of today looks very different.
It does. This is where we have to do the reality check, because the big question is, can they even survive long enough to get to 2026?
Financials are pretty grim.
Grim is putting it mildly. Let's just start with profitability. Their gross margin, trailing 12 months, is negative 49%.
So for every dollar of stuff they sell, they're losing 49 cents just on the cost of making it.
Before even paying for lights, salaries, anything. And it gets worse down the income statement. Net income last year was a loss of almost $17 million. But the number that just floors me is the EBIT margin. It's negative 616%. It just shows a total inability to generate value from their core operations recently.
And what's happening with revenue during all this?
It's been incredibly volatile. I mean, it's down over 50% in the last 3 years because of all this restructuring.
Okay, so the income statement is bleeding. What about the balance sheet? Is there any safety net there?
No. That's where the immediate danger is. The liquidity metrics are flashing bright red. Their current ratio is 0.2.
Meaning 20 cents of liquid assets for every dollar they owe right now.
Exactly. And the quick ratio is basically 0. They are in serious trouble when it comes to meeting their short-term bills.
And that kind of trouble is what leads to
the going concern warning, yes. The company's own auditors are on record saying they have substantial doubt that the company can continue to operate.
Yikes. And there's a score for this kind of risk, isn't there?
There is the Altman Z-score. Theirs is negative 3.81. Anything below 1.81 is the distress zone. This score is basically screaming near-term bankruptcy risk.
And on top of all that, they're just fighting to stay on the Nasdaq queue.
Constantly. They had to do that massive 1-for-64 reverse stock split back in September just to get the share price back over $1.
You don't do a 1-for-64 split unless you are absolutely desperate.
You do not. And it all leads back to their need for cash,
Right.
which brings us to the really wild trading dynamics happening right now.
Yeah, the price action has been just insane. A 52-week range from, what, under $2 to over $120.
That's not normal. That is pure speculation, and it points to a very unusual structure under the surface.
Let's get into that, because this is where it gets really interesting for traders. The volatility seems to be amplified by an extremely small float.
A microscopically small effective float, that's the key. Officially, there are about 5.7 million shares outstanding, but the number you can actually trade day to day, it seems to be way, way smaller.
How much smaller are we talking?
Estimates put the tradable float somewhere between maybe 180,000 and 480,000 shares, a tiny fraction of the total.
And why is that? Are they locked up by insiders?
It's a mix of things: insiders, long-term institutions, and probably shares that are restricted from the recent mergers. And you can see this scarcity in the cost to short the stock.
Oh, the cost to borrow. I saw those numbers. They're astronomical.
Between 480 and 590% annualized. You only pay that kind of fee when shares are incredibly hard to find.
So you have this tiny number of available shares, and then you have short interest of nearly 1 million shares.
Right. Nearly 1 million shares sold short against a float that might be less than half that. The pressure is just immense.
Which creates a classic short squeeze setup. But there's a twist here, isn't there? There's a deadline.
A hard, fixed deadline. And that is what makes this so unique. People are calling it the dilution gate.
The dilution gate.
Because the company cannot legally execute a massive share-diluting capital raise until after the annual shareholder meeting.
Which is scheduled for December 29th.
December 29th. And everyone is watching one specific item on the agenda.
Proposal 8.
Proposal 8, the request to increase authorized shares from 75 million to 3 billion.
3 billion.
Yes. If that passes, they can print shares to their heart's content, raise cash, and solve their liquidity crisis.
But it would also completely crush the existing shareholders through dilution.
Massively. And it would instantly remove the share scarcity that the shorts are trapped by. So you have this period between now and December 29th where the shorts are boxed in.
So the meeting is everything. It decides if the squeeze pressure continues or if the floodgates open.
It is the absolute pivot point for the stock's entire structure. So beyond that vote, the next thing to watch for is probably the Q4 earnings report.
Which should be around mid-January 2026.
Right. That'll be the first real glimpse we get to see if this new energy strategy is actually, generating any revenue at all.
And in the meantime, with this thin float, any press release could send the stock flying.
Oh, absolutely. Any news on that Rock Springs refinery deal, any mention of AI or new partnerships, it'll act as a massive trigger for volatility.
So to sum it up, you've got this really compelling story about a pivot to a high-tech energy future.
A great narrative for 2026 and beyond, but it's pinned against a financial reality that is, frankly, terrifying. Deeply negative margins, a severe cash crunch. It's a true high-risk, high-reward situation.
Absolutely. It's a structure defined by operational hope, constrained by financial reality, and a finite clock counting down to the December shareholder vote. If you found this breakdown useful, please make sure you subscribe, like, and leave us a comment. We appreciate your support, and we'll be back tomorrow with another analysis.